In the center of Oslo, there is a glass office building most people would walk past without a second glance. No marble staircase, no gold-plated logo, no billionaire's name carved into the facade. Just a quiet lobby in a quiet city. But inside that building, a small team of civil servants pilots something almost unimaginably large. Not a company, not a bank. A financial engine so vast it quietly owns slices of the global economy itself. The Norwegian Government Pension Fund Global. More than $2.2 trillion in assets as of the end of 2025. Invested in thousands of listed companies, government bonds, real estate, and renewable energy projects spread across nearly 70 countries. A nation of about 5.5 million people controls a pool of capital larger than the annual GDP of most G20 economies. And yet, inside that glass building, there is no victory parade. There are models, stress tests, scenario analyses stretching decades into the future. Because the people who manage one of the largest pools of capital in human history are not just worried about losing money. They are worried that the system which created this wealth is slowly, quietly starting to change beneath their feet. Imagine waking up responsible for a financial machine worth over $1 trillion. If markets move just 1% in a week, that swing can exceed the annual budget of smaller countries. But you are not chasing quarterly bonuses or trying to beat your neighbor's portfolio. You are effectively managing the future fiscal backbone of an entire nation. And hidden inside that responsibility is a problem most people never think about. Because the world's richest energy states, Norway, Saudi Arabia, Abu Dhabi, Kuwait, are not just managing wealth, they are racing a clock. The very thing that made them rich, oil and gas, is also the one thing they know they cannot depend on forever. Not because it disappears overnight, but because the world around it is shifting faster than expected. When your entire economic model is anchored on one dominant resource, you do not need that resource to vanish. You just need its growth to slow, and everything starts to feel different. This story does not start in spreadsheets. It starts underground. Some countries built prosperity slowly, through factories, trade routes, and decades of industrial development. Others drilled a hole and struck a fortune. Oil fields so prolific, gas reserves so large, that a single discovery could throw tens of billions of dollars a year into government coffers. At first, it looks like a miracle. Budgets swell, currencies strengthen. Living standards leap forward in a single generation. Then, economists begin to notice something strange. Countries that get rich quickly from natural resources often struggle to build diversified, resilient economies. Manufacturing stalls. Non-energy exports shrink. Innovation slows. This pattern earned a name: Dutch disease, after the Netherlands experienced it following major gas discoveries in the 1960s. Here is the basic mechanism. When a country exports huge volumes of oil or gas, it earns foreign currency, usually dollars. The domestic currency strengthens. A stronger currency sounds like a win, until exporters of everything else start to suffocate. Factories become less competitive. Local industries struggle to sell abroad. The economy gradually orbits around a single axis: energy. And that creates a fragile structure. If your tax base, your jobs, and your growth all depend on a single volatile commodity, you do not really control your future. Global markets do. Oil prices fall, your revenues fall. Demand slows, your budget tightens. If that lasts long enough, the social contract itself comes under strain. Some governments ignored this risk and spent freely. Others saw the trap early and made one of the most consequential financial decisions of the modern era. Do not spend everything. Save, and crucially, save abroad. The idea was deceptively simple and politically radical. Take a temporary windfall from underground and convert it into a permanent portfolio above ground. No more subsidies, not bloated payrolls, not just roads and stadiums, but financial assets, global equities, bonds, property, infrastructure, and now even renewable energy projects. This is how sovereign wealth funds were born. Norway set up its oil fund in the 1990s with strict rules. Spend only a limited share of petroleum revenue, invest the rest internationally, and insulate the domestic economy from overheating. Decade after decade, the fund grew, not just from oil, but from compound returns. Today, it sits above $2.2 trillion. It is now one of the largest asset owners on the planet. Norway is far from alone. Saudi Arabia established the Public Investment Fund, aiming to become a multi-trillion-dollar investor. Abu Dhabi's ADIA and Mubadala, Kuwait's Investment Authority, and others each manage hundreds of billions to around $1 trillion. Even Singapore, with no oil, constructed giants like GIC and Temasek, using trade surpluses and state savings. Collectively, global sovereign wealth funds now control close to $14 trillion and are taking a record share of the world's largest asset pools. On the surface, that is just staggering wealth. Underneath, it is something more uncomfortable, an admission that the source of this wealth is temporary, and that failing to transform it in time would be catastrophic. Here is the twist. The problem is not that oil is suddenly running out. Global demand is still around 100 million barrels per day and is projected to hover near or slightly above that through the next decade. Planes still burn jet fuel. Cargo ships still run on bunker fuel. Petrochemicals still sit at the heart of plastics, fertilizers, and countless industrial products. But markets are forward-looking. They move on expectations, not on the last barrel pumped. And many of the signals point in one direction. Electric vehicle sales are climbing, especially in China, Europe, and parts of North America. Solar and wind have seen sharp cost declines over the last decade, making them competitive with fossil fuels in many regions. Efficiency standards are tightening. Some regions are pushing aggressive climate policies. Major agencies now expect oil demand growth to slow, then flatten around 2030 under current trajectories, even if absolute demand does not collapse. This is where the math turns dangerous for petrostates. Many built their fiscal systems on the assumption that oil revenues would keep flowing and growing, more or less indefinitely. Those revenues pay for public sector jobs, fuel and food subsidies, infrastructure megaprojects, welfare programs, and often the unspoken cost of political stability. In some of these economies, the state is not just a regulator. It is the dominant employer, investor, and buyer all at once. That model works under one condition: strong, predictable energy income. Remove that assumption, or even dent it, and everything else becomes harder. You cannot endlessly expand government payrolls. You cannot promise ever-rising benefits. You cannot expect a single commodity to carry the weight of an entire generation. And while revenues face pressure, demographics push the other way. Populations are growing. Millions of young people are entering job markets each year with rising expectations. So the challenge is not just to replace oil revenue. It is to redesign economic systems fast enough that they can support a larger, younger population after the old model slows. Look closely at how sovereign wealth funds invest today, and you can almost read the future they are trying to buy. This is not just passive index tracking. It is a strategic rewiring of national balance sheets. They are not only buying assets, they are buying positions in future power structures. Artificial intelligence, semiconductors, renewable power, data centers, logistics networks, biotech, electric mobility, and more. Saudi Arabia's Public Investment Fund has become a major player in electric vehicles, tourism, sports, and futuristic urban developments. Abu Dhabi's Mubadala has deep exposure to advanced manufacturing and chip production. Singapore's Temasek is heavily involved in biotech, fintech, and next-generation platform companies. Norway's fund, largely index-oriented, quietly owns pieces of thousands of companies across almost every major sector on Earth. This is diversification, but not just for safety. It is diversification for survival, converting cash flows from a maturing resource into ownership stakes in industries expected to drive the next 50 years. If they get this right, they do not just preserve wealth, they change their entire economic identity. If they miscalculate, there is no second North Sea, no second shale boom waiting in the wings. Here is the paradox of success. The bigger these funds become, the harder it is to move the needle. For a small investor, a lucky startup bet can double a portfolio. For a trillion-dollar fund, even a billion-dollar win barely registers. So they are pushed into mega deals, infrastructure, large equity stakes, private equity platforms, and sector-sized partnerships. These are often safer and slower growing by design. That creates a structural tension. Governments still expect these funds to generate income that can substitute, at least partially, for oil revenues. But ultra-large pools of capital often struggle to beat modest, single-digit returns over time. Do the math. A trillion-dollar fund earning 5% throws off $50 billion a year. That is huge in absolute terms. But for states that once relied on vast energy rents, it may not fully cover previous commitments. So these institutions live with two conflicting imperatives: protect and grow the capital slowly, while also helping replace a shrinking revenue stream quickly. Doing both at scale, under political pressure, is one of the hardest balancing acts in modern finance. There is another layer: geography. Most sovereign wealth assets are not parked at home. They are scattered across the world. American stocks, European bonds, Asian infrastructure, global prime real estate. Geographic diversification reduces economic risk, but it introduces political risk. Those assets exist under foreign laws and can be frozen, restricted, or sanctioned in periods of extreme geopolitical tension. That reality reshapes behavior. These funds are no longer just optimizing for return versus risk. They are actively managing exposure to entire political systems. So the pattern is shifting. More co-investments, more joint ventures, more deals anchored in long-term strategic partnerships and friendly jurisdictions. Capital is no longer purely financial. It is increasingly a tool of foreign policy and alliance building. From the outside, sovereign wealth funds can look like monuments to excess. Skyscrapers, stadium sponsorships, sports franchises, luxury developments, headline-grabbing mega projects. But beneath the optics lies a much simpler truth. These funds exist because some governments have internalized a brutal lesson. Natural resources are temporary, but well-managed capital can outlive generations. Sovereign wealth funds are not just trophies of oil wealth. They are transition machines, designed to convert a one-time geological accident into durable economic and geopolitical power. Measured not just in dollars, but in what those dollars become. Factories, labs, data centers, ports, patents, and influence. It may be one of the largest financial transformations in history, not only in scale, but in intent. So the real question is not, will the world stop using oil? All major scenarios suggest oil demand will persist for decades, even if growth slows and eventually plateaus. The real question is this: can the wealth created by oil be transformed fast enough to thrive in the system that comes after it? Because this is not only an energy story, it is about control. The next global economy will not just be built, it will be owned. And right now, in glass towers in Oslo, Riyadh, Abu Dhabi, Kuwait City, Singapore, and beyond, some of the richest countries on Earth are racing, quietly, to make sure they still hold a meaningful share of that ownership when the age of easy oil finally gives way to whatever comes next.